What I wanted to share today is the real reason I trade. Honestly, the original reason was that I thought it was going to be easy, but I was wrong. It's definitely harder than it looks. But I kept going because I like what markets do. They don't care about what I want. They're neutral. They just evaluate my decision making with gains or losses. So the cleanest way to explain why I like trading is kind of broken down into three beliefs. First, markets give immediate feedback. The second one is that all decisions in life are trade-offs. And the third is that access to markets and how people click buy and sell, that's constantly changing and evolving. So all three core beliefs point to the same problem though, like in my experience. If I do not record the decisions I'm making in markets properly, I can definitely fool myself. Which is why I built the trading database that's like behind the performance record. So the main thesis that I have is that trading has more value than just trying to get rich. It's like this crazy battleground for training your judgment under uncertainty. So on top of that, the market provides gains or losses based on your decisions. So sometimes that feedback is instant gratification, but sometimes it's instant regret. But either way, it is feedback. And that feedback and data is very valuable. So the first belief is that markets provide this feedback quickly. You can form a thesis like today. You can choose when you want to buy or sell. You can choose how big you want the trade to be or the investment. And you choose what risk you are willing to take. When the market marks the decision, you're going to get your gain or loss. And it's kind of like a student waiting to get their marks back from a professor. Except the mark in trading has a lot of money attached to it. So that's why the feedback that you're getting from the market feels a little bit more intense than like something at school. But diving into the feedback a little bit more, being just right or wrong is not enough feedback. Like, you can make money, but it doesn't automatically mean that the decision was good. And if I lose money, that does not automatically mean the decision was bad. So the useful question is like, why? Why was I right or why was I wrong? Was it the thesis, the timing, the sizing, the structure, the risk? That's the actual more detailed feedback that I actually need. The second belief is that everything is a trade-off. And once you see that, you can't really unsee it. Like, just think about every decision you ever made in your life. You could go watch a movie or you could go to bed early. You could hold more cash or take more risk. You could watch price action all day or go to a job and just accept the passive returns from the market. So markets turn all these trade-offs into numbers and this feedback. So price, time, volatility, drawdown, they make all this trade-off decision-making visible. And it's kind of everywhere in life. The third belief is that the access to markets is changing. So, just the typical internet, smartphones, better software. Now we have the AI tools, which is just better software. But research, trading, automation, and record keeping, what I'm doing here with my database, that's so much easier than it used to be. And my belief is that participation in financial markets keeps getting more fluid over time with all the better tools and lower friction. So more people are able to click buy and sell like around the world. And I want to participate in that change actively and kind of look around for opportunities. When I mean look for better opportunities, there's sort of like the downside is that all this easier access does not mean better judgment. So that's kind of a trap. More access can mean more opportunity, but it also means more ways to just be a sucker. So I fooled myself for many years thinking that trading and active management was easy. AI can make the tools look easier and feel easier, but it doesn't make decision-making better. So judgment, behavior, and experience are still scarce skills, as in not many people possess them. So that's why having some sort of personal database matters. It makes honest evaluation of your decision-making skill, it makes it inevitable, but you have to do it. So the system can show returns, benchmark comparison, attribution, drawdown, risk breaches, mistakes, and all of it is like a source trail good for like auditing. So it lets me ask whether the active decisions I'm making are they actually worth it? And this is actually scary. It means I have to look at my own bad trades and stupidity. But if the record is honest, diagnosing problems within my process becomes so much easier. So the value is definitely there. My current standard is that a trade has to survive, a decent sized checklist. Thesis, timing, sizing, risk, liquidity, invalidation, and like post review. And if I actually could follow that standard, I may not make many trades. I may do nothing for months and just accept the passive returns. And I'm hoping that's a good thing. So the question is, what if the end state is that the data shows I would have been better off doing nothing? That's okay. Only time will tell, because time is the main function of wealth. So trading for me, beyond getting rich, is about training judgment under uncertainty and keeping a record that's honest enough so that I can learn from it, and it becomes like a research, educational, personal development tool. So this is my own portfolio I'm talking about, my own thinking process, and it's kind of just my own accountability system that I'm publishing. Nothing here is investment advice, and I do not work with clients, and this is not a recommendation. Thanks.